Hello, everybody, and welcome to the Crypto Hipsters Curtain Calls. This is your host, Jamil Hassan, the Crypto Hipster, where I bring you compilations of clips from podcasts from seasons 6, 7, and 8. This episode is episode 52 in the Crypto Hipsters Curtain Calls series, entitled Invisible Touch? How to Fend Off Your Inner Demons while trading cryptocurrencies by using automation tools, security measures, and risk management techniques. This podcast is a compilation of 4 interviews, 2 from season 7 and 2 from season 8. First person I spoke with, it's a wonderful conversation from season 7 in May 2024 with JOTARO. JOTARO is the co-founder at JOJO. And we talked about preserving security, transparency, and efficiency of decentralized trading environments. Second, it's a conversation I had with Chris Bradbury. Chris is the CEO of Summer.Fi. We talked in April 2024 during season 7 about how to leverage the benefits of automation tools when investing and trading for the next decentralized finance summer, DeFi summer with 2.0, hopefully, which hasn't come yet, and I hope it will come soon. We'll see what happens. My third clip from this compilation was with Georgii Verbitski, who was one of my first couple videos during season 8 in November 2024. Georgii and I spoke about why crypto options and structured products can help manage risk as we head into the bull market. And last but not least was an amazing discussion with Meg Lister, who is the managing director at Gitcoin Labs. We spoke in March 2025. We talked about how to transform Web3 capital allocations through successful grant funding programs and strategies. And a lot of these strategies involve smaller accounts, trading accounts, not just big institutions, but for people like you and me. So watch any of these podcasts, the clips on this show, and if you like the podcast and want to learn more, all my podcasts are available in their entirety on Spotify, YouTube, anywhere you listen to your favorite podcast. You can find the Crypto Hipster channel. Please do so. And my next season's coming up in April 2026. So, and that'll be season 10. So, this has been episode 52, entitled Invisible Touch: How to Fend Off Your Inner Demons While Trading Cryptocurrencies by Using Automation Tools, Security Measures, and Risk Management Techniques. Thank you for tuning in. I will see you next time. So I mentioned Bitcoin earlier, right? And a lot of people say that's the only inflation hedge. I disagree. I believe there are hedging strategies for DeFi protocols. What are some of those hedging strategies people can use?
I see. So, talking about hedging strategies, I think when people think about hedging with Bitcoin, they normally think about hedging the inflation. That like they hold Bitcoins and they can get rid of the inflation. But when we're talking about hedge on a perpetual future exchange, it actually it's a wider concept that it means that you want to open or close it means that you want to open a short or long exposure to some price. So if you open a long position with Bitcoin, it can somehow the same with the meaning of hedge the inflation. But also, if someone just want to hold USD and they just somehow like if they are Bitcoin miners and they are worried about that if the Bitcoin price going down, I cannot afford my electricity fee. I cannot, yeah, I cannot afford for the machine's price. How can I avoid that? So they want to like sell the Bitcoin that they even didn't mine. So they can open a short position on perpetual DEX. So that is called hedge. So they open a short position, and if the Bitcoin price going down, they cannot sell the spot as at a high price, but they earn from the short position. So while in total they just don't have the risk of hold Bitcoin. So that is one very typical thing that people can hedge using a perpetual DEX. And people can also use that to like make some funding rate arbitrage. Like if they also normally, uh, well, funding rate arbitrage is a little complex. I will try to explain, and you can decide that whether to show it to the audience. Um, so the perpetual futures has a mechanism called funding rate, and that is means sometimes the long positions should pay to the short positions, and sometimes in reverse. So that is some mechanism that make the perpetual futures price the same with the spot price. And most of the time, it's the long position holders pay to the short position holders. So there will be a strategy that you have USDC, right? And you buy some Ethereum spot. Then you open the short position with the same amount. So in total, you don't have any exposure to Ethereum price, but you will keep earning the funding rate from the long position side. So that means you will have a risk-free passive income from this strategy, the funding rate arbitrage. And that is really popular in the professional traders. And we can make it very easy for normal traders to earn from this. We will soon launch a product that can help you convert your USDC to Ethereum and plus a short position. And in total, it's always equal to $1, but it can generate around like 10% APY or sometimes 30% APY, very stable and with no risk. So that's funding rate arbitrage, and it utilizes the hedging strategy in a perpetual DEX.
Something that I want to shift gears a little bit now, towards DeFi users, right? And that includes DeFi, the regular users, which include traders or investors, right? Something I've never used because I've been a long-term holder only, and I've never like been an active trader. Is this concept of stop loss, right? Um, I want to find out why it's important to use stop loss when trading cryptocurrencies. And does that even make sense for somebody who is a long-term buy and hold only investor?
I mean, I think so. So we have stop loss on our trading strategies on Summer. I'm a heavy user of stop loss. I got stop lossed out, I think Friday, when the market drops. And I spoke at length recently with one of our product managers and user researchers about literally about how we both use our automation strategies and so on. But yeah, I mean, I think things like stop loss is an incredibly powerful tool. Like especially when combined with some of the other kind of like automation strategies that you can have as well, like such as like automated take profit, like on the other end as well. But yeah, I mean, even as a buy and hold, I mean, like when you look back to like 2021 and so on, like lots of people kind of rode that wave all the way up. And then it kind of came crashing back down in 2022. The same in 2017, kind of January 2018, it then came crashing back down. And the whole hodl thing was there. But in reality, like when you try and take the emotion out, like kind of like I'm not selling sort of thing. Like I'm a believer in this, I'm a holder in this. But in reality, like you could have stopped lost out at like maybe 3,000 or so. It fell all the way back down to like say 1,000 at some point, I think, in the midst of the FTX, so on, and then it started raising. Now, even if you didn't have the confidence to buy, because I think it's very difficult to kind of buy at 1,000, although everyone says like, oh, like I stacked my bags up further at the all-time lows or whatever, or the kind of lows of 22. Like it's actually very difficult to do it or to catch that bottom. Like at what point do you catch the falling knife? I remember 2017 or 2018 in particular, like the buy the dip was like buy the dip was everyone like Reddit or Twitter and so on. Like everyone was just talking about buying the dip, and it just kept going down, right? Like it's so hard to catch that falling knife. But let's say it then went up to 1,500 again, and that it was that kind of trending toward in 23. It was it felt flat, but it was slowly trending up. If you'd have stop lossed out to say USD or USD stable coin like DAI or USDC or something at say 3K or even 2.5K, and you bought back in at 1.5K, like you're winning at that point, right? Like you stopped your losses. Let's say it went all the way down to $200. In reality, nobody really knew how low it was going to go or how long it was going to go low. But if you get stopped out, then like particularly if at that point, let's say you bought in at 1,500 and you get stopped out at 3,000 because it went up to 3,500, you're stopping out in profit, and that is like such the important thing there. If you want to buy back in, you can buy in, and in fact you can then like buy in again at 1,500. Maybe it goes back up to where it is today at what it's hovering around 3,000, I think. But now you've pretty much probably doubled your stack at that point, because you kind of took the emotion, you took the emotion out of it in some ways to say, I'm just a holder, I'm never selling, I'm just holding. But like emotion gets in the way of the head a lot, and things like stop loss help take the emotion out of it. Like if you set your price, set your level, like I personally probably have my stop loss set way too conservatively. It's always like, I think I've been stop loss like 3 times this year already, because like I always had the paranoia of losing too much. So I often have the stop loss set around like between 5 and 10% lower than where it currently is, if I'm using Summer and using the multiply features and so on. And that means like, yeah, when there's a big dip on Friday, I get stopped out. I get stopped out to DAI. But for example, I've already bought back in, but I've got more ETH now from when I got stopped out on Friday, because I bought back in at a lower price, because the price did keep falling. It fell even further on Saturday. So I'm now in a position where I've got more ETH than I did do on Friday when I got stopped out. But had Saturday gone like worse and it would have fallen another 20 or 30%, I'd have still just been in dollars again at that point. And that's the power of stop loss. And the reverse of that is the power of take profit as well, which is again available on Summer.Fi, where you can set the price you want to start taking profit, and it will just slowly withdraw collateral from your wallet at regular set intervals that you choose. And it can take it out either as collateral if you don't want the exposure to the market. Let's say you're at 2.5 or 3x, and you want to take collateral out and kind of put it back at 1x, basically. Or more importantly, at least from my perspective, it can take it out in dollars. And if you're at say a 2.5x multiple exposure in say ETH, the price only has to go up 40% for you to have 100% of your principal back in your wallet, while still having the same dollar amount exposed to the market the whole time.
So you recap. You help traders, investors, miners. You said treasury managers, money managers, and startup companies too.
Yeah,
it's pretty good. And then the 60%. I know since the election, I'm up like 40-some%, but like 60% as an annual APR is pretty good. Like it's really great. You know, you're going to be defeating some of the best hedge funds in the world, right? So why shouldn't everybody, come on, use your portfolio, and why would they continue to still go the 60-40 bonds equity when they don't need to do that anymore?
I mean, that is just the results for last year. It doesn't mean it will be the next year will be the same, because there is some risk involved. Of course, it's not like staking when you just having the infrastructure risk of the big exchange who can go bust. Here you have some risk. Of course, it's not like a huge risk, but you have some. I mean, we have a drawdown for several months, and it's it's just an instrument. You can use it. You can use it with a good result, or you can use it with not so good result. It depends on you. I mean, maybe because I'm managing a model strategy, which is, and I'm quite professional in that. So I can achieve like 60% APR for a year, but you can do like 20-30% without any specific knowledge. And that is pretty good. That is pretty good. So we're not advising, go and use TYMIO without understanding. We're not promising. Of course, it's not a financial advice and stuff like this. It's just an instrument, and you can have drawdowns, of course, and not all companies or people are ready for drawdowns. It depends on the risk profile. If you are ready for the drawdowns, you can use it. If you are like super high risk, you can of course use options and futures by yourself, but you can be liquidated, and it's complex. You can be liquidated. You have to be professional. So we are giving tool for non-professionals, and it's relatively safe. You can use it without the risk of being liquidated. You will not go, like, when you're trading futures, you can go to and experience tilt. You know the tilt, when you like you wanna get back your money, and you lose again, and definitely you can lose everything. So not like this. This is a more like conservative instrument, but still relatively with high APR. So it's kind of something in the middle between like no risk staking. I mean, no risk. Of course, there are some risks, but market risk, no market risk staking. When you put your Bitcoin and you have like 10% per year, yeah, you can stake on Binance, you can stake on Bybit, something like this, and you have like trading when you emotionally can be involved, you can suffer losses, stuff like this, and we are in the middle, somewhere in the middle. So it's just kind of an option for people who like the middle thing.
So let me help the people understand. You differ from the Celsiuses and the FTXs of the past in that you're not rehypothecating people's money for them. You're just providing a tool that they can do it for themselves.
Yes, yeah, of course, that's a tool. And by the way, you mentioned FTX, and that's a centralized exchange. I mean, we are like we are non-custodial. We are based on smart contracts, so we are not. We don't have access to the customers' funds. I mean, this is a DeFi basis. So a smart contract is audited by the third party, and you can check the audit. It's public, and the smart contract is also open. It's public. You can check the code and to make sure that everything is fine. So basically, we are quite different from those companies that you mentioned.
Yeah. So let's stay in that lane and talk about retroactive, or quadratic. Let's talk about quadratic first, because I don't know what that is. So what is quadratic funding? How's it work? Why is it a great model?
Yeah, so quadratic funding came about probably 6 or 7 years ago, which we'll call, in eon in crypto time. And it came from actually a research paper that was authored by Vitalik, Glenn Weil, and a few other individuals exploring this problem of the same topic we've just been talking about. What are other models besides VC funding to encourage investment in the crypto space? And the idea behind it is that, VCs take a limited number of shots on goal, if you will. They invest in a limited number of projects. And VCs and any, individual can only have so much knowledge about the set of organizations that they're looking at. And that information is biased by, that individual's particular perspective, which is all to say, hey, what if there was another model, and what if we could really enable funding through collective intelligence from a community and from people who actually also really benefit or are really invested in seeing particular projects succeed? And so quadratic funding is built on collective intelligence rather than the intelligence or even the bias of a single or small group of investors. And the way that it works is, say that the Ethereum Foundation wants to fund startup developer tools on Ethereum, which they've done many times. And they're saying, hey, who better to make these decisions than the developers themselves? And so they say, hey, we're going to put $1 million behind this. But in order to make those decisions, we want the community to tell us what's most important. And the community is actually going to vote with their dollars. And so you and I were both Ethereum developers, and we put, $1, $2 in donations towards each of the projects we support, which count as basically votes towards those projects. So we've got skin in the game, and, we're invested in our small dollar way in how those investments should be funneled. Does that make sense?
It does, and I have a couple follow-ups. You used to talk about, back in 5 years ago, or even 7 years, 8 years ago when I came in, the strength of the crypto community, right? Because it was a smaller community, but it was very strong, right? You don't really hear about the crypto community anymore. You hear, I guess, do we still have strength in that community? It seems to have gone by the wayside. Why is the community still important?
Yeah, I think community is still incredibly important. And in my read, there's two things at play. One of them is that the tightest knit and most active communities also tend to be some of the smallest. And so naturally, as an industry expands, those original communities, they get bigger and they have more of those looser ties versus a small group of people with tighter ties. And there's an opportunity there for us to empower kind of almost like decentralized or smaller, more focused communities within crypto to replace the kind of monolithic crypto community that we've thought of in the past. The other thing is, I think that this is a perception that is really skewed by social media and the way that we communicate today. And every time I bring this up, I sound like my mother, but this is one of those times where I have to admit that she's onto something. And the discourse on social media has an obvious bias towards kind of rabble-rousing and negativity. And so the folks that you see on there are not the folks or the statements that you see gaining traction. They're not the unifying and uplifting ones that you might have seen in the past, or that are truly indicative of overall sentiment. You're just seeing what the algorithm's rewarding. And so I do think that there's still a lot going on outside of social media or behind the scenes with crypto communities that just isn't reflected quite as widely.
So then how do you discern between the collective intelligence of that real true community for certain coins and the biasness that is embedded in the algorithms?
Yeah, and I really think this comes down to finding other ways, both platforms and like activities or mechanisms for communities to engage. And quadratic funding is a perfect example of that. Again, not to sound like my mother, but nothing productive ever gets done on Twitter. And, I deleted it from my phone a couple weeks ago, and I've never been happier or more productive. What is actually, motivating and rewarding both for communities and the ecosystems they support is to give them a job to do. And that could be something like running a quadratic funding program and really harnessing, again, that intelligence that the community has.